Welcome everybody to QB Power Hour. Today is Thursday, January 24th, 2019, and today's episode is cleaning up the books in QuickBooks Online. Now, this is part one because cleaning up the books, it's a kind of a monster of a topic, and there's so many possible ways we can go with cleaning up the books. So I'll do the best effort I can think of to be able to cover at least some components of cleaning up the books in QuickBooks Online. So the agenda will spend about 5 minutes talking about the webinar, the sponsors, the CPE process. Then we'll move to about 50 minutes worth of content where we're going to learn how to make the adjustments in QuickBooks Online. We're going to be focusing on matching beginning balances and tax return beginning balances, and then we'll have the last 5 minutes open for Q&A. Now, about QB Power Hour, we're a webinar series, usually twice a month or every other Thursday. The next episode will be 2 weeks from now on February 7th. We don't have the topic for that, but Michelle Long will be doing that. And on the 21st, so 4 weeks from now, I'll be going in detail on the QuickBooks Online Advanced SKU, which is a different offering that QuickBooks Online Essentials or Plus, QuickBooks Online Advanced. It's a fourth option that QuickBooks Online offers to the public. It's about $150 a month. So on the 21st of February, we're going to go in detail in all the new features or different features that version has that the other versions don't. Now, we usually cover tips and tricks and advanced insights on QuickBooks Desktop and QuickBooks Online. We try to split the content 50-50. Today's 100% QuickBooks Online, by the way. And every once in a while, we'll have a special guest, third-party app. We'll talk about practice management or industry-related topics. Michelle Long, my co-host, she's doing a training in Miami, actually. She's actually 10 minutes away from my office. She's doing an advanced training down here, so she's not going to be joining us on the live presentation, but definitely check out her LinkedIn group and her numerous books she has in Amazon. About me, my name is Garcia. I live and work in the Miami area. I teach QuickBooks in my own classroom. We teach QuickBooks here, my own classroom. I happen to be in the classroom right now. Actually, I'll show you the classroom real quick. So I'm just showing you with a webcam so you can see it. So I'm actually in the classroom because I don't have space in my private office. I'm part of the Internet Trainer Writer Network, kind of a self-proclaimed expert in all things QuickBooks, Excel, integrated applications, and that sort of thing. There's my email and my Twitter handle if you want to communicate with me directly. About the CPE process, if you're logged in live and you answer the 4 polling questions, actually, you only need to answer 3 out of the 4 we usually answer. We ask at least 4. You will get your CPE certificate. Okay, so if you watch this as a recording in YouTube later on, there's no CPE, but only if you watch it live and only if you answer 3 out of the 4 polling questions. And it takes about 2 to 3 weeks for you to get your certificate. Okay. Now, I would like to thank Avalara, who sponsored our webinar from August of last year all the way to January of this year. So this is the last month Avalara will be sponsoring the webinar. We'll see if they renew, but Avalara is the most popular app or service to manage multi-state tax with QuickBooks Desktop or QuickBooks Online. So thank you very much for sponsoring, and check them out, avalara.com. Okay. All right. So these are the possible table of contents that I was thinking when it came to cleanup, and this actually happens to come from our Facebook group. And I'm going to log into the Facebook group real quick just to kind of show you where all this, it's called an inspiration, comes from. But we've been asking folks in different webinars and in Facebook, what is the most requested pretty much topic in QB Power Hour, and it has been cleanup. So I started a thread yesterday, and we have about 20 comments. And my question was, when it comes to QuickBooks cleanup, what exactly does that mean? What exactly are you looking for? What does that topic look like? And then we have like 20 answers, and literally every single one is different. Like how people call QuickBooks cleaning, or what people labeled as QuickBooks Cleaning, which is typically a service that a bookkeeper, a QuickBooks Pro Advisor, and accountant does for their clients at the end of the year. That seems to be different for everyone. So I'm doing my best trying to give you a good assessment of what those topics will be. I will be getting probably direct feedback from saying, hey, you need to cover this and you need to cover that. So this is part one of possibly a 4, 5, 6-part series on cleaning up QuickBooks. So what we're going to cover today is we'll talk about some typical methods of approaching cleanup. So I'll just kind of define those. And then I'm going to be covering today troubleshooting the balance sheet. It is the most common thing that we do, especially during tax season, where we take last year's balance sheet from a tax return, and then we look at the current QuickBooks file, and we match up the numbers and make reversals to make the current period accurate or make the current period tax return ready. So I will be covering, for the most part for today's session, that beginning balance aspect, and then we'll see how far we can go. But I'm suspecting that to go into very big detail into any of these, this has to be a multi-part series. So we'll see how it goes, and we'll get feedback from there, and we do that. So methods for cleaning up, and I was trying to narrow these down and make it into like sort of 3, and I think there's 3 overall approaches to cleaning up a QuickBooks file, and people may have a different perspective of this, but there's 3 ways to approach, hey, I'm going to clean up your QuickBooks. One is what I call a full audit, which basically means going into every single invoice, making sure it's accurate, going into every single bill, matching every payment with every invoice, every bill check payment with every bill, checking all the like literally spending months, right, a month or 2 in somebody's books, cleaning up transaction by transaction as if we were going to prepare the books for a financial audit. So that's typically a very costly thing. Most people would charge between $4,000 to $6,000 to do a work like this, and the average client in tax season, that's not really what they're looking at. In contrast, what most people are looking at is, here's my QuickBooks file, just get it cleaned up for my prepare, and then I will do it right in 2019 on. That's usually the most common sentiment that we get from our customers when they ask us to do cleanup. So that would be the second one, right? Just make cash basis adjustment, make sure it's all cash basis, ignore the balance sheet, and just make sure the banks are right and the categories are right. And then there's somewhere in the middle, right? What would be somewhere in the middle, which would be tying the numbers with the previous balance sheet, right? Reversing any bogus numbers that don't match the reality because the last accountant did something crazy. Then do the cash basis bookkeeping, and then at the end, just making a few accrual basis adjustments just to make sure that it makes sense. And that third option actually happens to be the most common. I'm going to go ahead and turn off my webcam just in case the audio starts shutting off. So I went ahead and turned off the video webcam. Hopefully the audio will get better. Okay, so let's move on to the actual demo. So this is what I'm going to do. I'm going to take the beginning balance of the balance sheet from last year's tax return. I'm going to look at our current QuickBooks file that we're troubleshooting. Let's say it's a new client with a new QuickBooks file. Then I'm going to make a whole bunch of journal entries to make sure that the balance sheet from the tax return matches the balance sheet from QuickBooks. And then I'm going to reverse the effect of those errors, because most of the time there really isn't. You're just going to see errors in the balance sheet. Okay, so I'm going to go ahead and switch over and open up QuickBooks Online. So I have QuickBooks Online open. I'm going to go into reports. I'm going to go into balance sheet. I'm going to go to last year. I'm going to click on compare another period, previous period, dollar change. That should always be the approach in which you look at a balance sheet, by the way. Always look at previous period dollar change. Click on run. I'm going to go ahead and zoom in a little bit so we can see a little bit better. Okay, so now we have our balance sheet here. And what we're doing in this case, what we're doing is we're going to make sure that the 12/31/2017 numbers from our tax return match our QuickBooks. That's our first step. Always has to be the first step. So let me bring this a little bit to the left here. Let me zoom out a little bit. Okay, that will be good. And then I'm going to open up my Schedule L. So I added in the attachment section in the handouts, you have access to these documents so you can follow along. So essentially what I have here, what I'm looking at on my right side, I'm looking at a balance sheet that was prepared on a tax return. And what I want to do is I want to make sure that every single line in this balance sheet matches my QuickBooks file. So I'm going to zoom out for a second, and I'm going to show you how to deal with each line, let's say one by one. So we're looking at 2017 tax return for last year on the right-hand side, and then we're looking at our current QuickBooks file on the left-hand side, and we want to match things up. So we're going to start with matching up the banks. So right now, our QuickBooks Online is showing bank balance of $110,729, and the tax return is showing $112,570. So there's two ways to go about this. One, we can say, oh, this is wrong, and we can try to figure out each bank account and what's wrong with it. But I usually don't start like that. What I do is I create one journal entry just to make it match, because my first step is to get the balance sheet squared up. And the second step is to choose whether or not you want to dig deeper to figure out why the beginning balance is off. Because there's two essential things that we're doing. One is we're setting up the first balance, and second, it would be figuring out how deep you want to go in terms of cleanup, right? So we're going to start with the first adjustment, which is simply just getting the $112,570 that's here on the Schedule L of the balance sheet to match into QuickBooks. So that's simply just a journal entry, okay? So that should be nothing new. So let me create a new journal entry here. Okay, so I'm going to create a new balance sheet account, and I'm going to call this one 2017 bank difference. Okay, so I'm literally creating a separate bank account just for this, just so I can see it, because there's some reversals I have to do at some point, and it's just really important that I go about doing this, right? So I'm going to go create a bank account. I'm going to call it 2017 bank difference, and then click Save and Close. And then I'm going to make this the difference, which is going to be a credit. So I'm going to take 112,570. Actually, it would be a debit because I have to increase. What's the current number? Yeah. Plus 112,570, or actually it would be minus 112,570. That's going to give me the debit amount. And then the difference, I'm going to move it to retained earnings. So this is something that a lot of folks just want to really stay away from, which is doing adjustments to retained earnings. In this particular case, I only do adjustments to retained earnings just because at the end of the day, I'm just getting the beginning balances to work, and I'm not really worried about what 2017 looks like in QuickBooks. I'm only worried about what 2018 looks like in QuickBooks. And essentially what I'm doing is making QuickBooks just work, adjusting the beginning balance. And this is going to be a 12/31/2017 journal entry, and then I'm going to click on Save. Okay, so now when I go back into my balance sheet and I click on Reports, okay, I don't know what I missed. I must have missed it by 3,000. Okay, so I did a problem in the math. The difference is really 1840.56. And I'll go back to my balance sheet and click on Run. And now this should work. Okay, so I got my correct beginning balance here, 112,570. Okay, so that's the essence of what I'm first going to do is just make the balance sheet work. Now it's 12:15, so let me run a quick polling question, so we can get over with the polling question, and then we're going to go a little bit farther down the rabbit hole here. So let me start with polling question. And this is the second out of 4 polling questions. You only need to answer 3 in order to get your CPE certificate. So if you miss the first one, you're fine by just doing this one. And while the polling question is up, let me just clarify something. I am ignoring 2017. I am completely ignoring 2017. I don't care what I'm doing to the books in 2017. And what I'm doing is I'm putting the correct ending balance to 2017 so I can clean up 2018. Again, so we're currently in 2019. We were hired to fix 2018. I'm ignoring 2017, and I'm creating journal entries to match my tax return for 2017 with QuickBooks so I can have a correct beginning balance starting point. Okay, so I want to clarify that because I'm getting some comments of people saying, well, you shouldn't touch retained earnings, this and that. That's not what I'm trying to teach you. I'm trying to teach you how to get the beginning balances right so you can focus on 2018 and 2018 only. Okay, so we have 90% of the votes. I'm going to go ahead and close the polling question. Thank you very much. And 41% of you love cleaning up QuickBooks files. Just I figured I would I would share that with you. So 41% of you love cleaning up QuickBooks files. 48% of you would do it anyway, and the same. And most people are just lukewarm about it. Okay. All right. Good. Okay. So that we did that was the first step. Okay. So let's go back and look at the balance sheet. So we have a second line here that says inventories. Okay. So it looks like we don't have accounts receivable. Actually, we do have accounts receivable, it looks like. So we have $7,500 in accounts receivable. Actually, let me delete that because that wasn't part of the math. Forget about the accounts receivable. Let's say there's no accounts receivable. And then we have $12,000 in inventory. So it looks like our balance sheet has $12,000 in inventory, but our QuickBooks does not. So let me go ahead and do a journal entry. And what I can do is I can work off the same journal entry here. So I'm going to go to inventory asset, increase that by 12,500, and the adjustment, do it again. I'm using retained earnings for now. Some people would say, well, you should use cost of goods sold. Again, I'm not worried about the effects of 2017 for now. I'm only worried about beginning balance. Okay, so I got the inventory in. Good. So now I got the inventory in. What else we have here? We have this thing called current assets attached statement. So usually when you have a tax return, and let me go ahead and open a different document, and I included this in the additional documents, as by the way, on the handouts. So usually when you prepare a tax return and you see a line in the Schedule L that says see attachments, you're going to have a different sheet of paper that's going to show you the breakdown of all the attachments that add up to that number. So it looks like, according to the tax return, the loan to Stephen Roberts, and there's a security deposit of $1,200. So the security deposit for $1,200 is here, which is good. That's here, but the loan to Steve Roberts is not. So we're gonna have to add that. Okay. So let me go back into my journal entry, and then I'm gonna come here and create the account loan to Steve Roberts. I mean, it's gotta be your job later on to ask the customer, hey, what's the deal with this loan, and try to figure out exactly what's going on. Why is it not in QuickBooks? Why was it in the tax return? That's a different exercise. For the time being, we're just making sure that our tax return is right. Because that's going to be $10,000, and then we're going to charge that also against retained earnings, and then we'll do save. So let's go back into our balance sheet and click on Run Reports. Good. So I got a bank balance. Good. I got my security deposit. Good. I have my inventory. Good. And I have my loan to Steve Rogers. Good. Let me open up my tax return. What else I have going on here? So I also have another asset here that says other assets attached statement. Okay, so there's an other assets account. Let's see what this is. So startup cost. Okay, so it looks like there's a startup cost for $5,000. So I come in here, do the same thing, and create an account called startup cost. Make this a other asset, $5,000, and run that against retained earnings. Okay, and then I click on save. So I'm using the same journal entry to kind of keep track of this. And I'm going to click on run report. And okay, what else we have? Let's open up the balance sheet. Okay, so we have what looks like some depreciation. So we have our total assets and then depreciation. In my experience, this stuff is never right. So you also have to kind of eyeball this. So let me fix that. Oh, and whoops, and it looks like I put 12,500 in the inventory. That should have been 12,000 even. I don't know where I got the 500 from. I'll fix that. Sorry about that. Yeah, it's hard without using two screens. Just I can't use two screens in the live presentation. So I'm just trying to work within the one screen. Okay, so I fixed that inventory. So the 5,000 a startup. Okay, so now let's take a look at the fixed assets. So usually what I do is I have to add up all the fixed assets that don't have accumulated depreciation and make sure that it matches the total fixed assets, and then adjust it afterwards if it needs to. But what I'll do is I'll adjust the accumulated depreciation first and then see what happens. So currently the accumulated depreciation is at 6,500. So I'm gonna come in here, I'm gonna add a line, and then I'm gonna add accumulated depreciation, and that's gonna be a credit because it's a negative number to my assets. And I'm gonna increase that. Let me see, what is it now? 6,500. So I'm gonna increase that by 3,500 by doing a credit, and then I'm gonna move this to retained earnings on the debit side. Hit save, go back into QuickBooks, click on run report. Okay, so now I'm just gonna quickly check, and it looks like the current assets were, the fixed assets were okay, because once I entered the accumulated depreciation, it matched up. So I got the 68,000 from my tax return, matching the 68,000 from the total fixed assets. Okay, what else we got here? Let's see. Okay, so it looks like we have these vendor deposits for 2,500 that actually don't exist in my tax return balance sheet. So I have to adjust that out and get rid of that. So let me go into here, and then I'm going to go to vendor deposits. Vendor deposits, I'm going to reduce that by 2,500 and also move that against retained earnings. Again, I'm getting multiple comments about retained earnings. This is 2017 and we're ignoring 2017. That's why I'm using retained earnings. I would never use retained earnings during a current period cleanup. It's only for the last year cleanup, okay? So now we have, let's see what else we got going on here. So I got my bank, I got 12,000, inventory, 10,000, secure deposit of 1,200. Let me hit run. Okay, so now my total assets, 2009, 277, match my tax return. That was the first step. Okay? Got to get the total assets from the tax return working. We're starting on a good foot. Okay, so we're moving forward. There are some potential issues here, right? Which is, our inventory changed, which is also pushing our inventory for 2018 to change. Our bank balance has this bogus amount that we had to plug in. There are some things that we have to fix and reverse. But again, what we're focused on is getting the beginning balances correct. Okay, so we got that. Let's look at the accounts payable now, or the liabilities. Okay, so let me zoom out. So it looks like we have 0 accounts payable, and my QuickBooks has something in accounts payable. Okay, negative 13,387.50. So for that, I'm going to enter a journal entry, and I'm going to put accounts payable. And I'm going to increase that through the credit side by that number, whatever bogus numbers here, 13,387.50. So I'm going to put here 13,387.50, and I have to create a customer, or a vendor in this case, here for the name column, so I can enter the accounts payable, because QuickBooks won't let you do an accounts payable unless I create a vendor. So I'm going to create a vendor, and this is what I always do. I'm going to create a vendor which I'm going to call AP 2017. That's the name of my bogus vendor that I'm using simply to adjust beginning balances of accounts payable, because I have to create a vendor. Okay, and that's going to go against retained earnings. I'm going to click on save. Okay, let's do a run report again. Good. So my accounts payable is now at 0. Then I got my Amex at 5150. Let's see what this says. Oh, we have this thing called other current liabilities attached statement, a total of 60,715. So let's look at the statement. Oh, and there it is. So we have to now match up all the current liabilities that's on the statement with whatever a QuickBooks has. Okay, so let's go through them. So the Amex, according to our statement, is 4132, and according to QuickBooks is 4150. So we just have to adjust that. So we're going to go to Amex, and that's 4150, 41. So we're going to lower that. So lowering a liability, it's a debit. So we got 4150. What's the cents? 0.80. So 4150.80 minus 4132. So 4150.80 minus 4132 tab. Okay, that's my difference, it looks like. Is that true? $18 difference? Yes, it is. Well, this happens. Okay, so I'm gonna run this against retained earnings. Hit save. Okay, good. Report. Okay, good. Now let's compare what else we got here. We got payroll liabilities at 8152. Okay, that matches. There's a customer deposit for 30,000. Okay, and QuickBooks has 27,500, so I have to adjust that. So I have to adjust this one. So we got customer deposits, and we have to increase the liability. So we're going to go to 30,000 minus 27,500. That should be 2,500. That goes against retained earnings. And then we'll save that. I know, guys, watching somebody do a journal entry is like watching paint dry. It's, you know, it's the nature of the beast, I guess. If you want to get specific training on how to clean up the books, you have to watch someone clean up books, I guess. Okay, so we got that, and let's say we got workers' comp. That's okay. That's the same. Looks like there's an equipment loan and a line of credit on the tax return, and it's not in QuickBooks at all. So we have to create those two. So we'll do equipment loan. That would be a long-term liability, assuming that it's more than a year to pay off, and that's going to be a credit of 73.67. Do that against retained earnings, and there's a specific reason why I do each line against retained earnings. I'll show you during the reversal process. And then there's a line of credit, and that's going to be a other current liability, and that's going to be 10,000. And that would be retained earnings. Let's go and save that. Let's go to QuickBooks. Click on Run Report. Okay, now the numbers are looking a lot better. There's my equipment loan. There's my line of credit. Oh, it looks like they have equipment loan on their other current liability. So I could change that. Let me go ahead and do that. Let me go into the chart of accounts here. And got the equipment loan. Change that to current. I just want to match the tax return as much as possible. Okay, that should take care of that. Let me hit run report. It closed. So balance sheet, last year, select period, previous period, dollar change, run report. Oh, very important. I've been doing this whole thing in accrual basis. Always make these adjustments in accrual basis. I forgot to mention that. All balance sheet adjustments should be done in accrual basis, okay, not in cash basis, right? We might have to dedicate an entire different episode to discussing the why of that, but just trust me on that one. Everything on accrual basis, okay? And then we have, it looks like loan from partners at 100,000, and then we also have a mortgage for 19,600. And in this case, no clue what this mortgage is, so we're gonna have to assume that the 16,600, it's probably the truck loan. So I may have to make the safe assumption of assuming that this 90,600 is the truck loan, or be the truck loan and something else. So I'm just going to adjust the truck loan as that. And again, we may have to look at documents and stuff like that in order to figure out exactly what's the difference. But we're trying to get 90,900 minus this number to get the truck loan adjusted. Okay, so that's a $1,900 difference. That goes to retained earnings. And then we're also going to have a loan from partners. Loan from partners. And that's going to be a long-term liability. And we'll make that 100,000 to match the tax return right here. And that goes against retained earnings. Hit save. Let's go on to QuickBooks and let's do a run report. Yeah, so now we're good. So now we got the last thing here, which is our partners' capital accounts. And the partners' capital accounts typically are going to be split up across all the partners. So I would probably suggest that we split those two up across all the partners. So let's assume that there's two partners, and that would be half and half. So let's go to journal entry here, and we'll do partner A, and that would be equity. Okay, and that's going to be half of that, so 28,912. And then we're going to do, that's going to be half of that divided by 2. And then we have partner B, and you could check who's got the capital by looking at the K1 on partnerships. On S corps, it's typically based on percentage, but you may have to look at the actual partnership capital accounts to know which partner gets what. But in this particular case, we're going to assign half of the capital to each partner, and then the entire difference goes to retained earnings. But there's also one more thing, which is this opening balance equity account. So I'm also going to adjust opening balance equity against retained earnings as well. So let's do it here. So opening balance equity, and that was 3970. So 3970, and then the difference goes to retained earnings, because that will be the last one that we're cleaning up. So I'll go ahead and click on save, and that should get my balance sheet 100% matching the tax return. Let's just double check here. Click on return. Perfect. Okay, I got my capital accounts the way it's supposed to be. My net income and my retained earnings are going to net out to each other typically because everything was moved into the partner's account, and it looks like I have everything else on the beginning balance good. So that's first step. All right, so let's take a quick break to do a polling question. And there are so many notes. There are so many questions in the questions box. I don't even know if I can get to all of them, but let's go ahead and run a polling question. And this is the stuff that, I mean, I do this this is what I do all the time. I mean, this is like every single day, typical accounting practice, getting QuickBooks cleaned up to match last year's tax return. That's always our beginning balance, okay? And everything to retained earnings because it's previous period. And that's the first thing. You guys start with getting the correct balance correct, so then you can start working on 2018. You typically can't start working on 2018 or whatever period you're looking for unless you start doing this. And yes, always make these adjustments in accrual basis, not cash basis. And at the end of the day, when you're finished, you can then adjust your accrual basis to make it cash basis, force it to cash basis with a journal entry, because QuickBooks doesn't really work really well with cash basis on journal entries to accounts receivable or to accounts payable. So I think you should always do all this in accrual basis, even if the client files tax returns in cash basis. Okay, so that's really really important. Okay. All right. So we got the polling. This is the third polling question that's up. And it looks like in average, the largest group here, it's 42%. So 42% of you are spending between 3 and 5 hours cleaning up each client in average. So that's an interesting stat. There's so much wasted time cleaning up books. It's incredible. I mean, the amount of wealth we could be creating by doing consulting work in all this time is night and day. Don't get me started on that rant. But for now, cleanup work is kind of necessary because you can't do a lot of consulting if the books are messy, right? Okay, all right. So now we got our starting point, which is our beginning balances are right. Then let me take a look at a different document. This document was also available in your handouts, and the reason I made those documents handy is just so you can follow along. The only thing you can't follow along is with a QuickBooks file because this is my own sample file I created for this. But let's talk about after we clean that up, then we have to get our reconciliations done correctly. So again, first I did a balance sheet correction, and then I'm gonna reconcile each of the bank accounts that I'm gonna start reconciling in 2018, and I'm gonna basically create an entry that's gonna force all these accounts then to be correct. So I'm no longer going to make these adjustments in 12/31/2017. I'm going to make these adjustments in 1/1/2018 because I want to post the difference to some sort of account. So whatever the difference is in all these beginning balances, I want to take in the error in the current period as an income or an expense of some sort. So I'll explain that in a second. So let's go ahead and do the reconciliations. So I'm going to go to reconcile. And I'm going to start with my checking account. So I'm going to go into checking account. Okay, I'm going to click on resume reconciling. I'm going to go into edit info. I'm going to enter that balance there, and that's the actual balance from the December 31st, 2017 bank account. I'm going to put that there, and I'm going to hit on save. Now, in this particular exercise, I went ahead and I identified which of those checks, okay, were pending. Okay, so I basically clicked on select all, and then I took out the checks that were pending, and by pure coincidence, this thing differenced out to 0. In the real world, this will probably never happen to you where you have a QuickBooks file that has 2 or 3, 4, 5, or 6 checks easily identifiable. You can select all, only uncheck those, and you're magically going to get a difference of 0. If you can obviously identify those checks and reconcile them or reverse them in the current period in 2018, and we may have to wait for part 2 to show you the actual reversing process of that. But if you can't identify those checks like the way I did here, typically what I do is I make sure that the filter here says a statement ending date, and then I come in here and I click on select all, yes, and then I'm going to force the difference. I'm going to force the difference because I can't move forward unless I have the correct beginning balance. So I'm going to force the difference, and I'm going to post it to an account of some sort. And we're going to have an accumulated errors account, which is going to be all the wrong things that were wrong with the QuickBooks file and the tax return. That's going to accumulate to something in the current period. And that could be taxable income, or it could be an expense. You're going to have to figure out with the tax person how you want to handle that amount. But bottom line, you have to take that error, and you have to take the current period and apply it to the current period. So I'm going to go ahead and force the reconciliation. I'm going to move this to the first of the year. I'm going to make sure that there's no transactions for 2018 marked here. And then I'm going to click on finish now. And then adjustment date 1/1/2018. And then I'm going to click on add adjustment and finish. So I click on add adjustment and finish. I'm going to click on done. Okay. Let me do the same thing with the other account. So it looks like my savings account is 12,500. So let's move to savings. Let's go to my savings account. And that should be 12,500 according to my bank statement. And it looks like I do have an error here somewhere. Again, I'm not spending any time looking at 2017. I don't care about what happened with 2017. I'm forcing the reconciliation because I'm going to do 2018 correctly. So January 2018, I'm going to do it the normal way I know how to do it. I'm forcing the reconciliation because I'm getting my beginning balances started. So I'm going to click on Save for Later. Whoops, it was actually finished now. So I'm going to go to Finish Now. I'm going to change the date to today. January 1st, 2018. The adjustment. I don't know why it's not letting me. I'll roll this back to December 31st, and then I'll change it afterwards. So let's roll that back. Hit done. And then the next one's going to be our payroll accounts, which is 250.90. So I'll switch that to payroll. We're going to make that 250.90. That's going to be January 1st, 2018. Make sure that there's no January 1st transactions here anywhere for 2018, only 2017 stuff. Perfect. Force the reconciliation. Finish now. Enter and adjust. Done. Okay, so I got my three accounts done. A petty cash account are, like always, our customers know what it's supposed to be. So I'm just going to make it 0. So I'm going to go to my petty cash account, and I'm going to make this 0. Okay, and then I'm also going to force a reconciliation. Finish now. Enter the adjustment. Okay, so before people start freaking out about what I just did, let's go into reports and profit and loss. I'm going to click all here for a second and click on run report. And then I'm going to look at my reconciliation discrepancies. Click them here. And I'm going to change this one to 1/1/2018 because I had screwed up with that one. Click on save and close. So what I'm going to do is I'm going to change this reconciliation discrepancies adjustments to one income account, which is going to be my accumulated balance sheet errors that I'm accepting in 2018. And at the end of the day, I'm going to look at that number. And if that number is within an immaterial amount, I just adjust my income by that. If it's a really big number, then I have to give some deep thought about how I'm going to approach those errors. So I'm going to create an account called Accumulated Errors from 2017 Balance Sheet. I'm going to make that an income account. Okay, so that's essentially what I'm going to do. I'm going to take all these reconciliation discrepancy adjustments and charge them against that. Well, I can't believe we only have 15 minutes left. Goes to show how much work accounting is. This recording would be useful to then send to your clients that are complaining about how much we're going to charge for our work, and say, you know what, go watch this 1-hour video and watch this person, spend an hour just cleaning up the beginning balance errors, right? This will be useful for people that are complaining that they think that bookkeeping and accounting is no work. Right? Way wrong about this. Okay, so that allows me all my beginning balances to be correct. So then when I go reconcile my bank correctly in the future, right? When I go reconcile, and I'm going to reconcile, let's say, my checking account, my beginning balance matches my last year's actual bank statement, I can move forward. My balance sheet is where it's supposed to be. There's another adjustment I have to make. So let's see how far we can get on the next 50 minutes or so. So the next one's going to be my Amex. So my Amex is 4150 according to the last bank statement on the 22nd. Okay, so let's do edit info. 22nd, 4150. Click on save. I'm going to click on select all. Yes, there's a difference. Again, I don't care about the difference. So I'm going to go finish now, enter adjustment. I may have to reverse that adjustment to the current period. Where's my profit and loss report? Let me run that again. By the way, if any of you think this is boring, I don't find this boring at all. I actually love this. I mean, it's the reason why I picked this career. Okay, so that's also going to be accumulated errors for 2017, and then click on save and close. Beautiful. Okay. And what else we got here? So we got our truck loan, right? So we verified the bank statement for a truck loan, and our truck loan is 17,995.90. So we're all going to reconcile our truck loan. I try to reconcile every single balance sheet account that has a sort of a document behind it. So let's do 17,995. What is it? Wrong one. I don't know what I pressed. Hang on a second. There it is. Okay, 17,995.90. So 0.90. And in balance, I'll just do it right this time. 1/1/2018. Select all. There's a difference. Sure. Finish now. Enter and adjust. Done. Let's run a report again. And I'm going to change this to my accumulated errors. And then click on save and close. All right, perfect. Okay, so let's run the balance sheet now. Let's run a balance sheet. And let's do last year, previous period, dollar change. Always do that, by the way. That needs to be instinctively previous period, dollar change. Okay, so it looks like I have to fix a couple things. So one, I'm going to reconcile every single bank account, right? My checking, my savings, my payroll, all for 2018. I don't know. I haven't done that yet. I'm not going to do this in this exercise. But once I reconcile, I'm going to make sure that my balance is right. One balance that I know is wrong for sure, it's this bank difference of 1840. So that I need to reverse for sure. I'm certain I need to reverse that. Okay. So that I have to reverse. So when I reverse that, it's a couple ways to do it, but easiest thing would be is just to click on it. Okay, find the journal entry. Okay, and then I can click on reverse, and I'll delete all the lines, all the other lines that I'm not touching in this case. So I'm gonna delete everything else. And now as I reverse that line in 2018, okay, I'm not gonna hit retained earnings anymore because I never hit retained earnings. In this case, I'm gonna hit my accumulated bank errors account. Again, there's no right or wrong account for those errors because we don't know where the errors came from. We didn't audit 2018 in this case. We're not auditing 2017, sorry. We're just making sure that 2018 is right, and we're just accumulating errors for the period. So that's fine. That's okay. I mean, when you get audited by the IRS, you have to then explain, how you came about that. In my opinion, that's okay. All right, let's see what else we have here. So if we go down the list, we have more things here. We have client confirming which are the real ARs, and client confirming which are the real APs, and client confirming vendor deposits, customer deposits, and undeposited funds. So once the customer actually, once they do this, okay, once they confirm with you what's a real AR, what's a real AP, or what the real balances are, you're gonna come in and fix that as well. So you're gonna fix AR, fix AP, all that stuff. Okay. All right. So let's see. Okay, and again, I want to emphasize on something, because the error is in 2017, and I wasn't hired to audit 2017. I am not spending the time to figure out why there's a difference, right? Because I only was hired to do 2018. But in order to make 2017 work, 2018 work, I have to force the 2017 beginning balance, and I have to assume the current, that error in the current period. Is it income? Is it expense? Is it distribution? I don't know. And I want to make sure, and I may have to put a disclaimer, this is not tax advice, and this is not accounting advice. None of this stuff is what you're supposed to do or what the rule is, or this is how I clean up the QuickBooks files, because I've never seen so many comments of people, just so mad about me teaching something that is not doing, checking every single line. I can't do that. That's not what I was hired to do. Like, people are up in arms in the comment section saying that they can't believe I actually do that. But this is how you clean up the file to have 2018 correct. This is the only way to do it, unless people pay me thousands and thousands of dollars to figure out why the beginning balance was wrong. So again, that's in 2018 is going to be done correctly. In 2018, you're going to reconcile every bank account. Right? So it's very, very important. Okay. All right. Let's see what else we got here. What else we got here? Okay. So we got the confirmed AR balances. So our customer told us that our confirmed AR balances is these two customers, one for 2,000 and one for 10,000. So what I do at this point, and this is hopefully I already reconciled the bank accounts, I already looked at everything, I already deleted duplicate invoices. All that process is done, and there may be a different part where we can cover that type of cleanup later on. So I'm going to run a report. That's my AR summary. So I'm going to go to my customer balance summary. Customer balance summary. I'm going to do last year. So last year. And a customer, let's look at, according to our document, the customer says, Hugh owes us 2,000 and Albert owes us 10,000. So it looks like one of the customers has the right balance, Hugh has the wrong balance, and I don't know who Gary Wisner is or whatever, that's the wrong balance. So what I'm gonna do is I'm gonna adjust it to make AR now $12,000. So let's go to the journal entry. And that's gonna be 12/31/2018. And again, I'm assuming that I already reconciled the bank accounts, I already deleted duplicate invoices, I already matched payments with invoices. All that homework was already done. So I'm fast forwarding to that. So I'm going to go to accounts receivable. And I'm just going to make a write-off, right? So I'm going to go to accounts receivable, and I'm going to write off Hugh Malozzi was one of them. Let me report again because I don't remember what the balances was. I think Albert was good. Hugh was different. Let's see, open balance summary. And last year. Okay, so we're going to adjust Hugh Malozzi by 2,500. So we're going to lower that by 2,500. And we're going to do Hugh Malozzi. And then we'll do another accounts receivable we have to adjust, which is increase it by 3,000, which is this guy, Gary Wisner, whatever his name is. Okay, so let's do Gary. Okay, and this Hugh Malozzi had a job in it. Okay, and then the difference, that's going to be under bad debt. Okay, so I'm going to have an expense account called bad debt, which I'm going to write off all the accounts receivable that our customers asking us to write off in a sort of universal way, not invoice by invoice, that sort of thing. So I'm going to click on save. So that will take care of that. And then for accounts payable, it looks like there's only one accounts payable for 8,500. So let's look at that report. So let's go to reports, vendor balance summary. And let's do last year. Okay, so we have to reverse this entry, the AP 2017 entry, and we have to make car building supply 8,500. Okay, so let's work off the journal entry. So I can open that journal entry there, and I'm going to reverse it, and I'll delete anything that I don't need. So I'll just keep that AP journal entry. So I have to just reverse the entire journal entry. Okay, so I have to reverse the entire journal entry that I forced in there because of the tax return. And then I'm gonna do another journal entry here. Okay, accounts payable. And that's gonna be reduced by 8,500. I forgot what the other balance was supposed to be. I think it was 12,000. So let's lower that by, okay, whoops, 12,000 minus 8,500, 3,500. Okay, so that's gonna be car. Okay, and the difference typically is gonna go to some sort of cost of goods sold, direct expense. This gets a little bit trickier because I actually don't know what the accounts payable for 2017 was, because I'm sort of avoiding the whole thing. But typically accounts payable is typically going to be cost of goods sold. So I'm going to look for like a cost of goods sold or a sort of direct expense cost. This gets really tricky, I would say. If I knew the actual vendors that I'm adjusting for, I can use the typical accounts that they would use. But because I got this weird one for 2017, I don't know. So I'm just sending it to a current cost of goods sold account, and then we'll make this end of the year, and then click on save. So that's going to get us as close as possible here. So we're on top of the hour. So I guess I would need like 30 more minutes or something like that to go even further. So what I'll do is, if you don't mind, I'm going to go ahead and just run the balance sheet here real quick. And I'm going to go ahead and end the webinar in the next couple of minutes, but I'm going to stay on. And I'm actually going to finish cleaning it up so I can show you just the last couple of things, not that much. So whoever wants to stay can stay, whoever needs to leave at the top of the hour can leave. So at least I feel that I can complete most of what I wanted to show anyway. So let's see, let's do the last polling question here. And before the last polling question, I want to ask you one quick thing. So in 2 weeks, next episode will be Michelle Long's topic. I'm probably going to pass the baton and ask her to do some like AR, AP, inventory, like detail level of adjustment. We'll see. I'll let Michelle pick the topic. And then on the 21st, so that's 4 weeks from now, I'm going to do deep dive on QuickBooks Online Advanced, which is that new SKU that's $150 a month, for that. So again, stick on an extra 20 minutes or so, or maybe 50 minutes as I finish the cleaning up. Maybe you learn a couple of extra things in the process. I want to ask you one quick thing before you leave. So I want to make a really pretty big announcement. So this season here, this tax season, will probably be my last QB Power Hour couple sessions. I wanted it to be today, but it's probably going to be the one 4 weeks from now. And I'm going to spin off a different webinar series that may have a similar name or a quasi-similar name. And I'm going to do all advanced content, all these type of things, what goes inside my head type of thing, and show you like actual, practitioner skills. And this is going to be premium content. I don't have a name for it yet. It could be Accountemy, it could be Accountant's Voice, it could be Art of Advisory, it could be Hector's Power Hour. Who knows? I'm still toying with the idea of what this will be called. I'm going to launch this end of April, and this will be paid only, right? Because I'm like just preparing for this one. As crackpot of an idea it is to clean up books the way I'm cleaning them. It took several hours to put the file together. So I'm doing only premium content. I mean, I'll still be doing some free content here and there. And I'm probably going to be charging $100 a month or probably even more. I'll probably be 2 to 3 hours of month of training per month. And there may or may not be CPE. I want you to email me what you think about this, right? So Hector Garcia at qbkaccounting.com. Email me what you think about this, your suggestions. What direction should I go? We have 630 people on this webinar watching live. I hope that you write down my email, send me some suggestions. I want to build something big, something awesome, something amazing for pro advisors and accountants that want to learn like really, really advanced skills or the most advanced skills. And it's with this webinar series that is free and sponsors, and between the sponsoring and all the process of getting the webinar started, it just takes away a lot of time, and I just want to do straight content and just advanced content. So I'll run a quick polling question real quick. Also be the last polling question for your CPE. So if you were to be excited about this, and you know, there's no right or wrong answer here, but and you would be paying something like $100 a month, what are the specific skills that you would want? I mean, like, what is it that you would pay for in this particular case? And again, still email me Hector Garcia at QBKaccounting.com for the specifics. You know, so any ideas or the name or which way it should go. But I think it's time to create the best paid premium content for QuickBooks Power users. I think QB Power Hour is. Obviously, it's biased because it's mostly my content and Michelle Long's content. But I think that when people pay and, you know, you have the commitment to deliver even higher quality content, and you don't have to deal with, you know, sponsors and all that stuff, I think it changes the whole dynamic. So I would really appreciate if you email me again, Hector Garcia at QBKaccounting.com, or any other email you have for me with your suggestions and what you think, which way I should go. I will take those into consideration. Okay, so I'm going to go ahead and close the polling question for the folks that need to leave. Okay, for the folks that need to go, and I'm going to stay on. So I'm going to stay on for about 50 minutes or so, and we're going to finish the cleaning up because there was a couple extra things I wanted to show you on the cleanup process. Okay. And I just want to know what's the most popular type of topics. I'll probably do multiple because these are the 5 areas that I could teach. I could teach hard skills, advisory, salesmanship, practice management, and strategic skills. I could teach all that. I just want to know which is the one that's mostly important. Okay. All right. Okay. So let me go ahead and close that polling question. So folks, stay on if you want to stay on. If you're leaving now, just remember to join the Facebook group and continue the conversation there, and ask your questions. And there's over 6,000 people in that Facebook group, tons of people proactively answering questions. Okay, all right, so let's go back into QuickBooks here and finish up this cleanup example that we were doing. So what we have left now is to do this last couple of things. So we just cleaned up accounts receivable, and we made it match what our customers told us it was, right? So our customers confirmed that these were the 2 customers, and they confirmed accounts payable as well. So is our accounts payable correct? Let's just double check. No, our accounts payable is all over the place. What the heck? Why is our accounts payable all over the place? Let's take a look at the accounts payable. I wonder why my accounts payable is all over the place. Let me save this. Okay. And let me run a report. Vendor balance summary. Let's do last fiscal year. Run. Yeah, so my vendor balance summary should be 16,000. So I think I screwed up on the direction of that journal entry. That journal entry should have gone the other way. So let me adjust that. Yeah, so I was trying to reverse this. So this should have gone this way. And so 3,500. And then the job related costs here. So let me hit save. And let's run the balance sheet again one more time. Okay. I don't know why my accounts payable is off like that. Let me check. Why is this thing is crazy? Let me give you some thought for a second. So we're on accrual basis, and we're looking at 2018, and our accounts payable $74,000. But when I look at my vendor balance report, let's see. Vendor balance, where are you? Vendor balance summary, there it is. And we do last fiscal year. That's curious. Let me do an AR aging report instead, because AP aging report instead. So that report seems to be all jacked up. Let me do an AP aging report. This is last year. Okay, yeah. So it looks like there's a whole bunch of vendors with ending balances. We had confirmed that car was 8,500. So it looks like I have to adjust this one journal entry one more time. I used 3,500. I should have used 3,000. So let me fix this one. But now the challenge we have now is that our customer is confirming to us that there's only one vendor that we owe money to, the 8,500, and the balance sheet or the AP aging has a whole bunch of stuff, right? A whole bunch of craziness. Okay, so typically what we end up doing at this point, right, is we have to go to every single one of these bills and figure out why these bills are showing up as open, because our customer is confirming that in fact there's only one vendor bill that should be open. So there's a couple ways to go about this. One, you can make a journal entry in a one fell swoop and just get rid of it, probably adjust it against job costs or something like that. But you probably want to, because a lot of these are current period, as a matter of fact, you would want to check every single bill and figure out why they're sitting there. Most of the times, in my experience, when your customer confirms that your vendor's balance is only one thing, and your reports are kind of all over the place in terms of the accounts payable, there could be a timing difference, right, where the customer confirmed with you that this is the only vendor that owes you money, but maybe you're doing this in February, and they're confusing the concept that they paid it in January, and maybe that's why this is happening, and that may be the case. So if you look at this particular case, it looks like that's the case. So as I look into these bills, it looks like these bills are paid in 2019. So our customer may have confused, what's owed and what's really not owed. For the time being, I'm just I already did the exercise. I'm gonna make the assumption that all these other vendor balances are right, because I already show you how to make the adjustment, so I don't have to go down the rabbit hole. On this, I have to fix it one more time. I kept putting the wrong entry here. This is 4,000 and 17, right? So I'm gonna make the assumption that just that one vendor we adjusted and we reversed the 2017 entry, and all the other vendors are okay. So I'm gonna just assume that all the vendors are okay, so we can move forward. So we have a couple more things here. Our client confirmed that our inventory was 5,000. Notice I put the word estimated, because most of my customers, when we do this type of work and you ask them for inventory, best thing they can do is estimate, right? They can't go any further. And if they don't pay me to audit the inventory, which I do that work quite a bit, but if they don't pay me to do that, then I'm not going to spend any time figuring out whether it's right or wrong. So I'll just make an adjustment into inventory in this case with a journal entry. So let me do a journal entry here, and current inventory is 4,500. So I'm going to put that into inventory value 24,500. Just double check. Yep, and that really should be $5,000 only. So I'm going to make that a credit because I have to reduce it. And the difference is typically going to go to cost of goods sold. In this case, I don't have a cost of goods sold account. Oh, I do have. There you go. Cost of goods sold. So I'm going to click on save. Okay. So that should reverse my journal entry. I mean, that my inventory asset. There we go. 5,000. And let's see what else I have on my notes. Oh, they confirmed that there's no vendor deposit and that there's no customer deposit. So let's see. A vendor deposit is at 0, so that's fine. And there are customer deposits. Okay, there are some customer deposits. So they're confirming that that there only should be 3,000. Oh no, wait. That there only should be 0. So I have to journal out that $30,000 customer deposit as well. So I'm going to journal that out. So we'll do customer deposit. And again, let me emphasize again on the fact that we already reconciled the books and we can't find it, right? So normally, hopefully, once you reconcile the books and you find those invoices or payouts related to it, you'll adjust them during the process. I'm fast forwarding and making the assumption that we've done all the reconciliation and we've done all the work that we can do, and then we're just cleaning up even further. Okay, so that needs to go against income, by the way. So anytime you reverse a customer deposit, that's always against income. Inventory, it's almost always against cost of goods sold, and a vendor deposit is typically going to be a cost of goods sold or an expense account of some sort, depending on who the vendor is. So we went ahead and reversed that. We reversed the customer deposit, and let's see, and then it looks like undeposited funds, this will be the last one. It looks like the customer, it's confirming that there's only one check from 2018 that was deposited during 2019 for $3,000. Everything else is wrong with undeposited funds. So the way we do that is we look at our current undeposited funds, and this is where they are. And again, assuming that we already reconciled the banks, we already identified what we could. So what we're going to do is we're going to go to bank deposit. We're going to do select all the undeposited funds that are wrong, okay? And we're going to leave the ones that truly we can confirm that were deposited the next year. So we're going to make a faux deposit, basically, a fake deposit. Doesn't matter which bank account here we pick. I'm going to send it to bank difference. At the end, it's going to be a 0. And then I'm going to send the difference to income. So I'm going to do whatever my income account is, and the difference is negative 9,000. And that's going to 0 out. So I selected all the old payments that were sitting there, and I don't want to mess with accounts receivable anymore. So when I leave the payments there, I'm going to deposit them against a negative income account. So the deposit is 0, and they go away from my undeposited funds. And then I hit save and close. Okay, and that's it. I mean, there's some sort of details and nuances left out because of the time that we have. There's some deeper research that we do in order to make sure that our deposited funds is right and all of that stuff. But I want to make sure that you know that this is the assumption that we made, right? We tied the previous numbers. Well, where is it? There you go. We tied the previous numbers to the balance sheet. We reversed all the differences that had to do with AP, AR, and the bank reconciliations. We did the cash basis of the bookkeeping, and then we made an accrual-based adjustment that makes sense. That means it made sense to the customer. So that's it. Let me open it up for Q&A because I have so many questions, and I'm going to try as much as possible. Let me unshare my screen at this point. All right, let's see what else we have. Let's see. Attempting to answer these questions is going to be tough. Okay, so we have a comment from Karen. I make a journal entry to true up retained earnings and balance sheet items to a new equity account called previous year adjustments. Okay, so I actually like that. So what she's saying is instead of coming to sending everything to retained earnings, create a new balance sheet account called, accumulated balance sheet errors or something like that, so you can visually see what all the numbers, where the numbers are going to. Okay. Okay. Good. So Karen, thank you for that comment. I actually agree with you on that. So use a different equity account instead of retained earnings, all those errors. Let's see. Let me see what else we have to say. Oh, before you make adjustments to the vendors, Deborah saying, before making adjustments to the vendors, call the vendors and figure out if they have statements or they can confirm with you that you do in fact owe them money. Hey, that's pretty good. I think that's a good one. But that's an audit. Okay, so that's an audit, right? Period. Now somebody is asking, what happens to that accumulated errors income account? Well, what happened to it is that you're taking the income or the adjustment to income. Let me share the screen again. Okay, I'll turn off my webcam. So one of the concerns here is, what's happening with our income account. So yeah, so what happens is I have this accumulated errors account that added up to like $14,000, which is income you're just going to have to assume, because the last, and this is the logic, the last tax preparer screwed up in one way, shape, or form and underreported your income by $14,000. and the new tax preparer, which is working with you, hopefully, it's making all the balance sheet balances work, and it's going to be good moving forward. And what you're doing is that you're assuming the error that happened, either last year or accumulated number of years. You're assuming it the current year. That way you can move forward. Now that's a conservative approach to take the income. What some preparers do is that they put it as equity, so it doesn't affect the profit and loss report. That's up to you, really. I prefer to just take the income and take the hit. That way, if I go through an audit, I don't have to deal with that. Let's see. Let me see. Somebody says that you should do all these concepts without journal entries. That's good point. So this training was meant to be like an overall cleanup, like a faraway view cleanup, not a line by line, match every payment with every customer cleanup. We've done that before, by the way. We've done other episodes where we talk about getting the AR right, getting the EP right, and the journal entries. We're trying to do something more tax season related, which is just basically a lot of volume that you're dealing with, and you may have to make some sacrifices in terms of details. Okay, that's it. I'm gonna end it there. We still have almost 400 people logged in live. Thank you very much, guys. Hopefully you got something out of it. Hopefully it makes your tax season more productive. And I will see you in 4 weeks on February 21st for the QuickBooks Online Advanced SKU training.